Welcome to the deep dive. Today we're looking at Wockhardt Ltd. They've just put out some key updates from their board meeting on November 3rd, 2025.
That's right. We're digging into the Q2 FY26 results, but, this isn't just about the numbers. It's really about a pretty fundamental strategic shift.
Okay, so what's our mission here? What are we trying to figure out?
Well, we're looking at two big things happening at once. One is a major change in their governance, a key board appointment. And the other is, well, the evidence of this big financial and strategic pivot they're making.
Right.
They're actually taking on significant costs to get out of an old line of business, while at the same time they're really doubling down on some high-stakes R&D.
And the data we're using, this is all straight from the source, right?
Yeah, absolutely. Official regulatory filings, financials, director profiles, plus a press release that gets into the details of their R&D pipeline.
So the main thing for you, the listener, to grasp right away is this company is making a really hard turn, moving away from, say, the more predictable U.S. generics market.
Which has its margins, but maybe lower ones.
Exactly. And they're committing, it seems, fully to the, let's call it, high-risk, high-reward area of developing new antibiotics.
It's really the execution phase of a major transformation. We need to look at who they've brought in to steer the ship, and crucially, whether the early numbers actually back up the gamble they're taking.
Okay, let's start right there at the top with leadership. The board has appointed Mr. Om Prakash Put. He's coming in as an additional non-executive independent director, effective immediately November 3rd.
Right. And what's really interesting here isn't just, hiring a well-known name. It's the type of expertise they went for at this specific moment.
Okay.
So Mr. Put, he was the chairman and CEO of the State Bank of India, SBI, for 5 years. I mean, that's one of India's largest, most complex financial institutions.
Wow. Okay, so that's huge experience in managing capital, dealing with massive regulated organizations. But his background isn't only banking, is it?
That's the key point. For the past 10 years, he's been an independent director on a really diverse range of boards. We're talking international banking, sure, but also automotive, steel, IT services, consumer goods, even renewable energy. The sources say he brings a holistic outlook. His focus areas are apparently sustainability, new investments, values, and culture.
So if Wockhardt is making this big shift away from generics, which is often about volume, towards novel R&D, which is capital heavy, high risk, why bring in a finance and governance heavyweight with such varied non-pharma experience?
I think you've just hit the nail on the head. It signals a shift in priorities, doesn't it? When you're making a high-risk R&D pivot, you absolutely need disciplined capital allocation.
Right.
And you need strong governance to manage investor expectations, navigate regulatory hurdles. You don't necessarily hire an ex-CEO of a giant like SBI for deep pharma insights.
Oh.
You hire him for his ability to enforce discipline, manage systemic risk, and provide that comprehensive long-term strategic guidance. It suggests they're gearing up for a marathon, not just a quick race.
And the proposed term reflects that too.
Exactly. Recommended for 5 years until November 2030, though it needs shareholder approval. It definitely underscores that long-term perspective.
All right, so we've got the long-term vision potentially set with this new director. Now, let's look at the numbers. Is there financial proof this strategic cleanup is, actually bearing fruit? Let's unpack the Q2 FY26 report.
Okay, so if you look at the top line first, consolidated revenue for Q2 FY26 came in at INR 782 crore. That's up a bit from 738 crore in Q1. It's modest growth, but okay.
But the real story seems to be profitability.
Oh, absolutely. That's where the drama is. They reported a profit before tax PBT of INR 91 crore in this quarter, Q2.
Which sounds good, but you need context, right? What was Q1 like?
Exactly. To really appreciate that 91 crore profit, you have to remember that in the previous quarter, Q1 FY26, they posted a significant loss of INR 109 crore.
Wow, so that's like a 200 crore swing quarter on quarter. That's pretty dramatic.
It is. It's a very strong signal of operational recovery. And you see it in the EBITDA too, that grew 58% compared to the previous quarter, hitting INR 160 crore.
Okay, impressive turnaround. But to really get the picture, we need to understand what caused that big Q1 loss in the first place, don't we?
Yes, because that loss was basically the cost of making this strategic pivot possible.
Ah, right.
So the consolidated results for the first half of the fiscal year, ending September 30, 2025, they included this one-off exceptional item charge. It was INR 97 crore.
And that was the cost of what, specifically?
That was the direct financial hit from exiting the U.S. generics business.
So that's the rip the Band-Aid off moment we talked about earlier, a deliberate, painful decision.
Absolutely deliberate. Back on July 11th, 2025, they started voluntary liquidation proceedings, that's Chapter 7, in the U.S. Bankruptcy Code, for two of their U.S. subsidiaries, Morton Grove Pharmaceuticals and Wockhardt USA LLC.
Okay.
So that 97 crore charge, that's the impact of deconsolidating those businesses, writing down investments, intercompany loans, all of that.
Take some guts to just shut down established subsidiaries like that. You're sacrificing the short-term numbers for presumably long-term clarity.
It definitely requires leadership courage, yeah. Strategic clarity over immediate P&L pain.
Okay, so that sounds like a classic pivot. But, taking a nearly 100 crore charge to leave a market, even a low-margin one, and then betting the house on high-risk novel antibiotics, that's still a huge gamble. Does the filing mention how they plan to fund things like phase 3 trials if, say, their main drug candidates hit a regulatory speed bump?
It doesn't go into the specifics of reserve funding, no. But the commitment to R&D spending is pretty clear. In Q2, R&D was 4.4% of sales, which is significant.
And they're seeing returns on that spend.
Seems so. In terms of intellectual property, definitely. They filed 7 new patents just in this quarter and got 5 granted. That brings their total patents held up to 858. They're building an IP wall around this new strategy.
Okay, so we've seen the cost of leaving the past behind. Now let's look at the future they're investing in this novel antibiotic pipeline. Let's start with ZAYNICH, also known as WCK5222.
Right, and the news here is, well, it's genuinely groundbreaking. It needs some context. The company finished submitting its new drug application, the NDA, to the U.S. FDA in September 2025 for ZAYNEC.
And this drug targets
Complicated urinary tract infections, CUTI. Specifically those caused by some really tough gram-negative bacteria.
Okay, an NDA submission is always big news for a drug developer. But why is this particular submission so globally significant?
Because, and the sources are very clear on this is apparently the first time ever that an NDA has been submitted to the U.S. FDA for a drug that was entirely discovered and developed by an Indian pharmaceutical company.
Wow, okay, that is a landmark. It's moving Indian pharma from primarily being, a world leader in generics
Generics powerhouse, yeah.
to being a primary innovator on the global stage. That's a huge shift in status.
It's potentially profound, yes.
Yeah.
And ZAYNCH isn't just focused on the U.S. It also got a breakthrough medicines designation from the Saudi FDA back in July 2025. So international recognition is building.
Okay, what else is in the pipeline?
Well, then there's Micunaf, or nifithromycin. This one's actually already approved and launched in India as of May 2025.
Oh, it's validation.
Pretty strong global validation.
Right.
The phase 3 study results, this was for community-acquired bacterial pneumonia, or CABP. They were published in The Lancet. I mean, that's a top-tier, globally respected medical journal.
Right, that carries a lot of weight.
It shows this isn't just, niche research. It's meeting global scientific standards.
And they also have existing antibiotics gaining recognition.
Yes, EMR and EMRO. These target-resistant gram-positive infections, things like MRSA, they were just included in the Clinical Infectious Disease Society's official diagnosis and treatment guidelines, the 2025 update.
So this whole pipeline seems directly aimed at the global crisis of superbugs, or antimicrobial resistance AMR.
Absolutely. And that ties into another key drug, WCK4282, which they're calling AFISCU. This one is a really critical piece in their AMR strategy.
Okay, what's the latest on that?
They just finished enrolling patients for the phase 23 study. That involved 324 patients suffering from complicated urinary tract infections, CUTI again.
And what's the specific goal with WCK4282? Why is it important for AMR control?
So the aim here is to establish WCK4282 as an effective weapon against infections caused by ESBL-producing bacteria.
ESBL, it stands for.
Extended spectrum beta-lactamase. Basically, these are bacteria that have evolved clever defenses against many common, powerful antibiotics. Very hard to treat.
Right.
So if Wockhardt can show that WCK4282 works well against these ESBL infections, the hope is it can reduce our reliance on drugs like meropenem.
And just remind the listener, meropenem is often seen as a last resort antibiotic.
Exactly. It's one of the big guns doctors turn to when other things fail. If WCK4282 proves to be a good, reliable alternative for certain infections, it helps us preserve meropenem's effectiveness for when we really need it.
So it helps protect one of our most critical defenses against the really dangerous bugs.
Precisely. If it works, this drug could have a really positive impact on global AMR control by helping manage the use of our current last-line therapies.
Okay, let's shift gears slightly and look at the global business segments. The financials underline that geographic shift we talked about. 79% of their global revenues are now coming from outside India.
Yeah, the international focus is clear. And the sources show, interestingly, the fastest growth right now is coming from their Irish business. That shot up 40% year-on-year, bringing in about 59 crore rupees.
And the other major regions?
The India business contributed 172 crore rupees. That's about 3% growth year-on-year. And the UK business, a significant chunk, was 313 crore rupees, showing 4% growth year-on-year. So steady performance there, but Ireland's the growth star this quarter.
But if we're looking at the strategic future, the segment that seems to really validate this shift towards higher value products is biotech, isn't it?
Oh, absolutely. Biotech operations really stood out in Q2 FY26. They brought in INR 154 crore. That represents a huge 41% growth compared to just the previous quarter, Q1.
41% quarter on quarter. Wow. What's driving that surge?
A lot of it seems to be fueled by their biotech segment in emerging markets. That part grew by over 50%. The strategy here is clearly focused on building leadership in the biotech diabetes market.
And that involves expanding geographically, too.
Yes, pushing into new, high-potential markets. The sources mention Russia and Malaysia specifically.
And new products coming.
Correct. They're highlighting their commitment to providing affordable insulin globally. And backing that up, apparently, is the upcoming launch of new insulin analogs in the next few quarters.
Okay.
So that represents another major potential revenue stream, reinforcing that commitment to global diabetes care. You see how this aggressive growth in high-value biotech runs perfectly parallel to the novel antibiotic push.
Yeah, it's the same theme. Both segments prioritize complex R&D and innovation over, say, the older generics model, which was more about scale.
Exactly. Sophistication over sheer volume.
All right. This has been a really fascinating deep dive. We've seen a company really trying to reshape itself. Just to recap the key points, we saw that clear commitment to strong strategic governance with Mr. Bat's appointment.
Bringing in that high-level oversight.
Then the necessary, if painful, financial correction, getting back to a positive PBT, even with the significant cost of exiting the U.S. generics market via Chapter 7.
Taking the hit to enable the future strategy.
And then, maybe most excitingly, the signs of that massive R&D investment paying off, particularly in novel antibiotics, highlighted by that landmark ZYNCH NDA submission to the FDA.
So when you put it all together, what does it really mean? I think the sources paint a pretty clear picture. This is a company actively and probably painfully executing a long-term plan. They are definitively moving away from the lower margin volume game of generics, especially in the U.S., and betting big on high-value, high-impact areas like novel antibiotics and biologics on a global scale.
A strategy built on IP and innovation, not just operational muscle.
That seems to be the core idea, yes.
Okay, so that leaves us with a final thought for you, the listener, to mull over. Considering the global urgency around superbugs, the whole AMR crisis, and the immense resources needed to fight it, what's the real impact, both immediate and long-term, of ZAYNCH being the very first Indian-discovered drug submitted to the U.S. FDA?
Yeah, think about that milestone.
How does that single achievement born from this strategic pivot and investment potentially change the entire perception and maybe even the future capability of Indian pharmaceutical innovation on the world stage? What doors might this open?